Calgary's real estate market just posted some concerning November numbers, but before we dive into our local data, you need to understand what's happening in Canada's economy right now, because I just came across some economic indicators that frankly shocked me, and they're telling a story about 2026 that almost nobody is talking about. By the end of this video, you'll understand why I'm both hopeful and skeptical about Alberta's economic future, what November's market data really means for buyers and sellers, and why the next 60 days could determine whether we're headed for recovery or deeper correction. Okay, full disclosure, as you guys know, I am not an economist, but I'm constantly digging through economic data, trying to find indicators that can help us predict where our real estate market is headed next. And I found something that I think is absolutely fascinating and honestly, a little bit alarming. Canada just released something called the PMI reports for November. That stands for Purchasing Managers Index. Now, stay with me here because this matters for real estate. So, what is PMI? It's basically a survey of business managers in manufacturing and services asking them, is your business expanding or contracting? Are you hiring or laying off? Are new orders coming in or drying up? A score above 50 means the sector is growing. Below 50 means it's shrinking. Here's where it gets concerning. Canada's manufacturing PMI came in at 48.4. That's the 10th consecutive month of contraction. Think about that. 10 straight months where manufacturers are reporting declining output, falling orders, and cutting jobs. It gets worse. Canada's services PMI just dropped to 44.3, down from 50.5 the month before. That's the lowest reading since June and means the services sector, which is about 70% of our economy, just fell off a cliff. New business orders are falling, export orders are collapsing, and companies are cutting employment at the fastest rate since the middle of COVID in 2020. The Composite PMI, which combines both manufacturing and services, dropped to 44.9. That's deep contraction territory. Now, here's why this matters for real estate. When businesses are contracting, they're not hiring. When they're not hiring, household income stagnates. When household income stagnates, people can't qualify for mortgages or they delay buying. And when people delay buying, housing demand drops. But it gets even more specific than that. The surveys are showing that business managers cite one thing over and over as the reason for contraction: trade uncertainty and tariffs. The US-Canada trade relationship is hanging by a thread. The USMCA is up for review in 2026. Trade negotiations have broken down in key sectors. I mean, Carney said, who cares? And Canadian manufacturers are getting crushed by tariff costs that they can't pass on to customers because demand is too weak. So we have manufacturers who've been contracting for 10 straight months, services businesses that just had their worst month in 5 months, and all of it driven by trade uncertainty. That's the national picture. But here's where Alberta comes in. You've probably heard about this big memorandum of understanding between Premier Smith and the federal government. A new pipeline to BC, emissions cap removed, hundreds of thousands of future jobs promised. My initial reaction, skepticism. But I watched an episode of the Loonie Hour podcast, an excellent Canadian economics podcast, so if you're not watching it, you really should, where Heather Exner-Puro made some points that shifted my thinking a bit. I want to share her perspective because if I'm being honest, there's a case for optimism here alongside my concerns. Immediately, Alberta got the emissions cap removal is done. Companies can now grow production for 5 years without hitting an arbitrary cap. That's attracting investment right now. And here's something I didn't know. Trans Mountain is adding 360,000 barrels per day. Enbridge is expanding by 400,000 barrels per day. That's 760,000 barrels combined. Almost a new pipeline worth of capacity happening now, not in 2030. Now, what will Alberta pay? The industrial carbon tax jumps from $95 to $130 per ton by April 2026. That's 4 months away. That's a 37% cost increase that Alberta producers pay immediately. Now, where I'm still skeptical, submit to Major Projects Office by July 2026, approval in 2 to 3 years, operation by 2030 to 2031. Yeah, I'll believe it when I see the shovels in the ground. But Heather's case made me pause. Trans Mountain and Coastal GasLink both got built despite the same opposition we're hearing now. The legal framework exists. There's $10 billion in Indigenous equity participation planned, and a private consortium is expected to come forward with a proposal in early 2026. Private money, not just government promises. Plus, she argues we're at a unique moment in the commodity cycle. Canada is the only large democracy with significant long life oil reserves. When US shale peaks in 3 to 5 years and oil hits $80+, the economics for this pipeline become overwhelming. Now, where I land, I'm more hopeful than I was after hearing her case. The emissions cap removal is real. The near-term capacity expansions give breathing room. The political shift seems genuine. Stephen Guilbeault resigned immediately after the MOU was signed. See ya. But I'm still doubtful we'll see that Pacific pipeline by 2031. And I'm concerned we're paying higher carbon costs today for promises a decade away. If the emissions cap removal drives investment, we could see oil and gas hiring into 2026, so I guess right away next year, that supports housing demand. If the pipeline gets built on schedule, massive economic impact in the 2030s. But that's too far out for current decisions. If this political theater, Alberta just agreed to a 37% carbon tax increase for nothing. I don't know which plays out, but after Heather's case, I'm willing to entertain the possibility that this time might be different. Now, let's look at what that economic uncertainty is doing to Calgary's November market. The Calgary Real Estate Board just released November data. So let's break down what is happening metric by metric. And more importantly, I want to explain to you why we're seeing these numbers. So November sales came in at 1,553. That's down 13% compared to last November. Why are we seeing this? Okay, so 3 main reasons. First, affordability. Even with rate cuts, qualifying for a mortgage is still tough. The stress test means buyers need to qualify at roughly 7%, and with median household income under pressure and 7.8% unemployment in Alberta, fewer people can qualify. Second, buyer hesitation. When buyers see inventory climbing and prices falling, even if it's only 4 to 5%, which I should say is specific to higher density, they wait. Why buy today when it might be cheaper in 3 months? That wait and see mentality kills sales velocity. Third, seasonal patterns. November is always slow. People don't want to move during the holidays. But here's what's interesting. The decline isn't uniform. Detached sales down only 5%, semi-detached down 3%. Those are relatively modest. Row home down 22%. Apartments down 28%. That split tells us this isn't a broad market collapse. It's specific segments getting hammered while others remain relatively stable. New listings came in at 2,251, down 3% from last year. So sellers are stuck. If you bought at peak prices with 1.5% mortgage rate, you're now looking at either taking a loss or walking away with minimal equity. Most people choose to just not sell. They wait. Renewal pain is real. Homeowners who might have considered selling are focused on surviving mortgage renewals. When your rate jumps from 2% to 5.5%, I mean, that feels extreme, maybe 375, but you're not thinking about upsizing. You're thinking about affording your current payment. Now, the termination strategy. Sellers whose properties didn't sell in October to November, December are pulling listings now to avoid the Christmas dead zone. More on that in a minute because it's important. But notice, new listings are only down 3% while sales are down 13%. That's a problem. The ratio between supply and demand is shifting, which brings us to, this is the big story. Inventory is at 5,581 units, up 28% compared to last November's 4,355, and over 15% higher than typical November levels. So why is inventory climbing so aggressively? New construction is flooding the market in specific segments. CREB's economist said it perfectly. Supply gains are occurring in higher density sectors, row and apartments, partially related to new home supply hitting the resale market. Look at the inventory splits. Detached up 32%, semi-detached up 50%, row home up 38%, and apartments up only 14%. Wait, apartments have the smallest increase? Yes. But apartment sales are down 28%. So even though inventory isn't growing as fast in absolute numbers, demand has collapsed so completely that supply is backing up. That is a demand problem, not a supply problem. So geographic concentration, let's look at this. Northeast, North, and East districts are getting hit hardest, exactly where most new multifamily construction has been concentrated. West, Northwest, and South districts have less pressure, less new construction, more diversified employment base. So, months of supply hit 3.59 in November, up 48% from last year's 2.43 months. What does this mean? It tells you how long it would take to sell all current inventory at the current sales pace. Under 2 months is a seller's market. 2 to 4 months balanced, over 4 months is a buyer's market, like roughly. At 3.59 overall, we're upper end of balanced, approaching buyer's market. But that average hides massive variations. Detached are at 2.97 months of supply, so balanced. Semi-detached, 3.29, balanced. Row, 3.51, balanced, leaning buyers. Apartment, 5.5 months, buyer's market. Why does this matter? When months of supply crosses 4 to 5 months, sellers lose pricing power. Buyers have choices. They can be picky, which they should be anyways, can negotiate hard. Apartments at 5.5 months, sellers are in weak negotiating position. Price 5% above comparables and you are invisible, like you're not selling. Detached at 2.97, sellers still have some leverage there. The trend concerns me. We've stabilized from mid-year deterioration, but we haven't reversed. And if spring brings the inventory surge I'm expecting, months of supply could push well above 4 across most segments. Moving on, benchmark price for total residential is $559,000, down 4.6% from last November's $586,200. But massive variation again by property type. Detached is $733,000, down 2.1%. Semi-detached, $761,700, down 0.5%. Rows are $424,400, down 6.2%. And apartments are $309,300, down 7.2%. So why are we seeing these price declines? I mean, when supply exceeds demand, prices fall. We've got climbing inventory, falling sales, rising months of supply, all pushing prices down. In communities that are competing more with new builds, you will see more price reductions in the semis and detached home market. Apartments and rows are competing with new supply coming on. They also just have more supply in general. Geographic prices show the same story. Hardest hit, Northeast, down 7.2%, the North down 6.8%, and the East down 6.3%. So holding a little better is the West, down 2.9%, the Northwest down 3.1%. Year to date is interesting. Even with November's decline, detached prices year to date are up 1%. Semi-detached up 3%. So if you bought detached or semi in January, you're likely still ahead. But apartments and rows year to date down 2%. Buy an apartment in January, you've lost value. What drives prices though? Employment and affordability. As long as unemployment stays elevated and mortgage qualifications remain tight, demand will be constrained. And constrained demand with rising supply means continued price pressure. Now, given these market conditions, I need to talk about something that could seriously backfire come spring. A lot of sellers whose properties haven't sold are pulling listings right now with plans to relist in spring when the market gets better. Full transparency, I am terminating at least 2 of my team's listings right now. So I'm not saying never terminate, I'm saying the when and why matters. I'm pulling to avoid dead holiday market time when nobody's shopping. But I'm relisting early January, not April. Here's the problem with waiting for spring, in my opinion. Inventory is already up 28% at 5,581 units. Spring always brings the massive listing surge. March, April, May, Hundreds of other sellers are pulling listings right now with the exact same wait for spring plan. You're all coming back at once, creating massive competition. And remember those PMI numbers showing economic contraction? That doesn't fix itself by March. My strategy is relist early January when inventory is still manageable, beat the wave of terminated listings coming back in March, April. If you need to sell, price realistically now, or time your reentry before the spring flood. Don't assume conditions improve when economic data suggests otherwise. For buyers, the best opportunities are apartments and rows in the Northeast, North, and East. 5.5 months of supply means real negotiating power. Don't be shy about offering 5 to 7% below asking on properties that have been sitting. Detached and semi-detached in west, northwest, south are holding value better, less opportunity for deep discounts, but more stability long term. Watch for terminated listings coming back in spring. Those sellers are motivated. Sellers, price realistically. We're seeing 69% sales to new listing ratio, so well-priced properties still move. Overpriced by 5% could mean 60 plus days on the market. Selling detached or semi-detached in strong districts, you're in a better position, but still need to be competitive with current comparables. Consider January, February over waiting for the spring surge. Now, the truth here is, the economic data doesn't support a quick recovery, but challenging doesn't mean impossible. Sellers who price right and time strategically will succeed. Buyers have real opportunities, especially in multifamily. This is a slow adjustment, not a V-shaped recovery. I know this isn't super positive, and frankly, it kills me to be negative. If you found this video valuable, please like and subscribe. I'm here if you have any questions. You can book a call with me in the link below. Thank you so much for watching. I really appreciate it, and I'll see you soon.